This $100 could be the start of a wonderful journey for you. And in this video, I'm going to show you exactly how you can turn it into an ETF portfolio that'll make your dreams come true. Don't worry, it's easier than it sounds. After all, many individuals we researched for this video turned just $100 into a $1 million ETF portfolio using the same advice. Now, while I'm not promising you'll get the same amazing results, I'm confident that you can do great things with just $100 too. So if you're ready to take the leap and start investing in ETFs, then grab yourself a pen and paper because this guide's going to be chock full of useful tips for beginners. From the various ETFs that you can choose from to the platforms where you can get free stocks, I'll be covering it all in this video. So without further ado, let's jump right into it. Alright, so first things first, let's dive into what an ETF is and why you should be investing in them. I'm sure you've heard the term floating around, but what exactly is an ETF? Well, ETF stands for Exchange Traded Funds, and it's basically a type of pooled investment security. In simpler terms, it's a basket of stocks that you can buy in one purchase rather than buying just one stock at a time. This means that ETFs can help you diversify your investments without having to buy a bunch of individual stocks, which is pretty amazing if you ask me. What's even better is that ETFs can actually be bought or sold on a stock exchange just like normal stocks, so they're very easy to buy and sell. For example, let's say you really like tech stocks and want to buy one Apple share. When you buy that one share of Apple, you're only invested in one particular company, Apple. However, if you wanted to invest in multiple tech stocks all at once, then one thing you can do is actually buy a tech ETF. By buying the ETF, your money's spread out over many different tech companies. Now, one great thing about ETFs is that many of them out there on the markets actually offer really low expense ratios. We'll get more into this later on. But an expense ratio is just pretty much the fee you're paying to the company to basically handle that ETF. So for example, a 1% expense ratio is going to mean that for every 100 you have, $1 of that will go to the ETF company as a fee per year. 1% is pretty high, as we'll talk about later on. But yeah, there's so many out there that charge as low as like 0.03%. As ETFs tend to be more cost-effective and more liquid compared to mutual funds and index funds overall, as an investor you can benefit from these advantages. In addition, ETFs are quite tax efficient. This is because when you hold an ETF in a taxable account, it will usually generate very little capital gains compared to buying individual stocks. Since ETFs track the performance of a portfolio of underlying assets, most trades within the ETF are made internally by the fund manager, and they're not exposed to investors. This means that you won't have to pay capital gains taxes on any of the trades made within the ETF. The last and probably the most important pro for investing in ETFs is that it can be much safer than buying individual stocks. As I mentioned before, when you buy an ETF, you're spreading out your money across many different companies. So if one company's stock goes down, then you won't lose all of your money. That shows ETFs can help reduce the risk associated with investing in stocks since there's less volatility compared to individual stocks. Now, as with anything in life, there are some cons to investing in ETFs too. So let's talk about those now. One of the biggest downfalls is that not all specific industries have ETFs available. So if you're interested in investing in a particular industry, you may not be able to do so through an ETF. Additionally, ETFs are usually not ideal for people who want to trade stocks and take higher risks. Although there are some more risky sectors and industries that offer ETFs, these will still be less risky than holding individual companies. Another con is the fact that if you're looking for high dividends, then yes, there are some high dividend ETFs out there. But in general, the dividend yields are going to be lower than holding particular stock. At the end of the day, it's really up to you when deciding which type of investment vehicle is right for you. ETFs offer some great advantages and can be a perfect way to diversify your portfolio without having to manage multiple individual stocks. Before I move on to the steps of building an ETF portfolio, I want to quickly touch on the two main types of ETFs, passive and active. Passive ETFs are the ones that I recommend investing in, since they have lower fees. But let's take a quick look at each type so you can decide what works best for your investment strategy. A passive ETF is one that attempts to replicate the performance of an index or a benchmark, such as the S&P 500, and usually has a low expense ratio of less than 0.10%. When you buy a passive ETF, it's like buying one share of the index or benchmark that's tracking. So you don't have to worry about a portfolio manager making decisions for you, since it's just tracking the index. On the other hand, we have active ETFs, which actually have portfolio managers that are making decisions about which securities to include in the portfolio. A very famous example of this is the ARK Innovation ETF. Usually there's a public figure or investor that's at the head of these types of ETFs. Generally, they have higher fees than passive ETFs since there's a team actively managing the portfolio. The upside is that you can benefit from the expertise of the portfolio manager. However, there's also a lot more risk involved. Now, when it comes down to picking up the right one, there are definitely some things that you should be looking at. For example, the expense ratio. As I said before, these fees can really add up and compound over time, so try to aim for an ETF with a fee rate of less than 1%. So what I mostly do is I compare a few ETFs with similar investment strategies and then choose the one with the lowest expense ratio. You can also look at things such as the performance or track record of the ETF to see how it's performed over time, as well as other factors like risk management strategies that are implemented in order to reduce volatility in times of market turmoil. So now that you've got the basics down, let's move on to how to get started investing in ETFs with as low as $100. First and foremost, you're going to want to sign up for a brokerage account that allows you to buy and sell stocks. There are plenty of brokerages out there, so it's important to do your research and find the right one for your needs. For a lot of beginners, I just recommend going with something like Webull or Moomoo, since they offer zero commission fees and are really easy to use. Plus, for a limited time only, Webull's giving out tons of free stocks when you sign up, so it's definitely worth checking out. What I actually recommend is to sign up for both Webull and Moomoo if you haven't already, since this way you can get a ton of free stocks, which is a great way to kickstart your ETF portfolio. I've already created an account on Webull, and I'm going to show you how to purchase your first ETF with them. So right now I have Webull pulled up on my phone. Let's go ahead and start the process of buying our first shares. Right now I've opened up the SPY ETF, which is going to be one of the most popular ETFs that a lot of beginners get. And here's where we're actually going to be able to buy our first shares. So I'm on the trade page, and I'm making sure that I'm on buy versus sell, because obviously we want to make sure that we're buying, not selling. You can also select your order type, so there are many different types of market orders. But to make it easier and be able to give the option of buying fractional shares, I recommend just going with a market order. Now let's go ahead and select the amount we want to buy. So as you can see, one share of SPY is trading at about $409. If you don't have enough money to buy one full share, you can buy fractional shares with Webull. So let's say I want to buy 0.2 shares of this ETF. So that's going to be a fractional order, and it's going to tell me my estimated amount is $81.78. And from there, we're going to click buy and then confirm. And that's it. Once you hit confirm, your purchase is done and you're officially an ETF investor. That was really easy, right? Now, if you want to invest in a different ETF, the process is the same, but just with a different ticker symbol or stock name. Before going to buy, though, I recommend doing your due diligence and researching the ETF you want to invest in to see what type of returns it's had in the past. Also, make sure that it aligns with your objectives and risk profile. So that's my quick overview on how you can get started investing in ETFs with as little as $100. I hope this helps you out, and if you have any questions or need additional help, comment below and I'll be sure to help out.